With very big pleasure. First of all, to say, it was a phenomenal experience to be part of the discussions in Davos. You might have all seen the big media news, Prince Charles launching a new sustainability initiative for the finance industry. Greta Thunberg, again, reminding us on the call for action. Beyond that, multiple commitments from the investor community that have not maybe been publicly advertised, but I had the fortunate position to be part of some of them. One of them, for instance, calling for commitments towards more net carbon zero emissions, a call that was also made before the World Economic Forum by the former chairman Klaus Schwab. I participated directly in discussions with Towers Watson's new Climate Coalition for Investment Resilience. It's a $5 trillion coalition by IPCC and ultimately backed by Towers Watson and multiple stakeholders across the investment, across the policy and regulatory / the corporate industry. So a phenomenal momentum again in its own right, and probably will convene many experts from around the world on some of the most prevailing issues and risks that we are facing today. And they were highlighted in Davos as well. You can probably see them here on screen. So first of all, Davos publishes every year a global risk report that looks at the interconnectedness of E, S, and G and economic issues. So these are environmental, social, and corporate governance issues that I'm dealing with in my day-to-day job and through my engagements. And it was striking to see that for the first time in the 20 years now of this report, climate-related issues dominated all of the top 5 long-term risks in terms of likelihood, and a large scale as well in terms of impact. What's been interesting to see as well is the interconnectedness of some of the issues are highlighted. And if you look at these risks that are here on screen in regards to the global shapers, or the global shaping risks, so to say, you would see on the far left-hand side extreme weather conditions, biodiversity loss, climate action failures around the world, natural disasters. So these are ultimately, as well as the human-made environmental disasters, these are all the climate-related risks we are talking about. And they're very much interconnected with other issues that you might see further on the right-hand side. May they be societal, may they be geopolitical. And I give you another example here. For instance, social stability. In this context, the negative downside instability is very often closely aligned with the climate change risks we are seeing these days, given, that, for instance, migration that is due to droughts, heat stress, etc., large-scale fires we're seeing in Australia now, but also elsewhere in the world, less so reported, that these type of activities have a real impact that might lead to mass migration. And that in that context might lead to ultimately the social instabilities and polarization, another social issue that we have seen increasing over the last decade drastically. And hence, it's fair to say, even though we are seeing environmental, social, and governance risks very often treated separately in assessment methodologies, what is happening in my industry is that we are looking more from a macroeconomic and from a microeconomic perspective on how these are getting increasingly intertwined and interconnected. And we'll look at that in a moment again. That is exactly what you are referring to and what I'm trying to explain here in the context of really scope and scale of the sustainable finance, sustainable investment movement. So we're talking back 20 years again, when the first social responsible investment funds vehicles were actually launched, and we started seeing 3 concepts shining through that are very much now prevailing these days in the context of sustainable investing and sustainable investment approaches. And these are ultimately screening, integration, and engagement. And in the context of sustainable investment growth, we have seen in the same time that the initiatives that happened initially around the fringes and a very sort of fragmented approach to socially responsible or ethical approach, ethical investments, has now grown to a sustainable investment and sustainable finance movement across investment and capital markets. And that's exactly what that slide highlights over here. So on the top left-hand side, you can see ultimately that assets that these are the assets in the investment management industry, have grown to somewhere around 30 trillion US dollars. And by the way, that's a significant growth momentum over over the course of particularly the last decade. And in the same time, you can see that signatories, these are investment managers, asset owners, and service providers at large, that signatories to the UN Principles of Responsible Investment Strategies, the leading founding body, so-called the PRI for the industry, has actually grown from initially commitments around 4 trillion US dollars. And I was fortunate enough to work for one of the asset managers at the time that actually helped to launch the initiative, up to around 80 trillion US dollars by the end of 2018, now into 2019. And we probably will get figures for 2020 very shortly. What's also quite interesting is that last year, the capital market side finally launched its own initiative together and through UNEP-FI, that's the UN's Environment Program. And they actually launched the Responsible Banking Principles. And they have now commitments from more than 130 banks in between this stat here and our talk. And they are literally having volumes committed of around 50 trillion US dollars now. That means a third of the entire banking sector volumes of, tradable securities, loans, activities are committed towards responsible banking. And that will mean that we will see not just only sporadic initiatives around green bond issuances that some of you might heard of, or some of the green lending and loan activities. We will see a much more strategic shape and shift in this industry as well, where ultimately banks that are committing to the principles will have to look at integrating sustainability issues from a strategic, from an operational, and from a transactional, so products and services standpoint. So that means the opportunities for these organizations as an entity, as well as ultimately the products and services that we are seeing that we can also buy as consumers, they will hopefully increase drastically again over the next decade. And what's shaping this all? There is a big momentum that's supporting these initiatives. And that's, of course, the momentum of ESG data and information, research and ratings. So the industry would have not grown, and that's fair to say, without having the ESG research and ratings data providers. And ultimately now the entire industry of service providers looking into the areas of ESG. And I'm in the fortunate position to work for Moody's in this role of strategic partnerships and engagement. So I work with entities around us that we have a stake in that actually provide sustainability research and ratings information, and that were fundamental again in shaping the industry. And I've worked over the course of my career in multiple organizations that were again fundamental in this industry to bring data, analytics, and indices, also in the context of ESG, to the forefront of financial markets. So when we started this journey 20 years ago with socially responsible, ethical investment strategies, we actually were very much here in the UK at the forefront of these developments. But what happens now is that we're getting increasingly confusion around definitions, around different type of approaches or strategies. And I have a dear friend who's worked most recently on a paper on defining and shaping the industry, and trying to build more rationale around the different approaches. And probably three are now most prevailing. One is actually the traditional SRI, ethical investment approach. The second one is an ESG integration / sustainable investment approach. And the third one is up and coming and by force is impact investing. And you can see that here as well on this slide with a study that I was fortunate to participate in. It was actually a UK government-backed initiative, the Social Impact Investing Task Force. We convened in 2018, and we actually compared 16 different classification frameworks for impact. So there are a variety of different frameworks out there that are helping to give us more ideas and definitions around either sustainable or socially responsible investing, but also increasingly around impact investing. And the major differences between these different strategies is actually around the approaches, the goals. And the approaches, hence, very often differ quite fundamentally from what we classify as financial first-led initiatives and approaches and investment strategies. So that means you want to create a financial return, you want to protect your assets from risks, versus ultimately the other side of the equation, which was historically more classified as a philanthropy initiative, is ultimately creating meaningful outcomes and impacts. And hence, these are impact first driven initiatives. The Global Thinkers Forum's initiatives looking and working alongside the Sustainable Development Goals, for instance, is a very strongly impact first driven initiative. If you would utilize that as an investment strategy, you could potentially also see that you're increasing value. So there you're increasingly moving from the right-hand side, and that's now well understood as an impact investment strategy. You're moving from the right-hand side of just looking at outcomes only at all costs, that you're actually creating values and efficiencies, which in turn create value and financial value. And hence, the lines between what we are now no longer seeing as only responsible or sustainable or impact investment driven approaches, these and goals, these type of lines are getting increasingly blurred. And that's again what this piece of information in our research also try to show. So ultimately, it's about avoiding harm and mitigating risks. It's about benefiting all stakeholders. Again, one of the key calls at the Davos Forum, and to contribute to solutions. And these are solutions that are ultimately for businesses, investors, and society at large. And maybe just to add a last point to that, even the regulators are now looking at alignment. This is no longer a movement on the fringes. We looked at the asset growth. We looked at the capital markets momentum, and we should add here as well that there is a transition from normative to regulatory frameworks and standards. And the EU Commission has convened in 2018 as well as an expert group, the technical expert group, and they have proposed a taxonomy for green criteria and categories. They are looking into proposing a green bond standard, more mandatory disclosure around ESG issues for investors, for corporates that exists already. And ultimately, they look at defining new structures for other what we call rules-based approaches and products, such as indices. There will be two types of indices that have a climate-aligned focus, and there has to be in future ESG disclosure on all index products. And that means, there's a transition in the market as well that we're seeing from more active fund management investments into passive investments, so index-linked funds, ETFs, exchange-traded funds, and others. There is a phenomenal growth in that area in its own right. And through actually more disclosure around ESG on these instruments, especially indices, which are impacting obviously the active as well as the passive management industry, we will hopefully see much more clarity and transparency around meaningful, what we call material issues. And that in turn obviously will lead to further reporting and disclosure also by companies. There has been a lot of work done to actually look at corporate financial performance now and corporate sustainability performance. So CSP and CFP correlations. And what you can see here on the left-hand side is a meta study. That means there are 2,000 studies combined looking for results, stats, and ultimately correlation ideally. You can see that all of them have identified a positive correlation for ESG and ESG combined between the two areas. And on the right-hand side, you see a study which is, for me, quite another outstanding achievement, because historically it was always used as an excuse when we look at why asset owners, asset managers are not investing in line with sustainability, that this might actually have an impact on their so-called fiduciary duty, because investing with a screen or an integration approach in mind would mean you would diminish your positive returns. And that, of course, would then mean, in turn, you would actually mitigate or diminish your fiduciary duty obligations. And these are legal obligations for trustees, managing large-scale pension funds. But with these studies, we have actually turned the industry on its head, because we have shown here that if you focus on material issues, so these are again the key ES or G issues that impact a company in a specific sector, that that you can actually achieve a good performance on these material sustainability issues, and hence significantly outperform companies that have a poor performance on the same issues. So that means in turns, at a company level, you can outsmart and outperform against your peers. And most importantly, for investors, that means you can create that alpha signal. You can create that outperformance by investing with a sustainability strategy in mind, at least over the medium and especially over the long term. Exactly, here you can see it's another project slash study I was involved with the Towers Watson Thinking Ahead Institute, a working group that convened actually on ESG in active and passive investment strategies. And we actually looked in the first instance on defining the key macro themes and trends, again, the ones that are also making an impact, and making it into the reports at Davos. You can see the reference further down here, so the Global Risk Report. And we were looking at going beyond ESG, environmental, social, and corporate governance issues. So we looked at picking and dividing the wider macroeconomic themes into societal aspects, into issues and opportunities around technology, into the macroeconomic context in line with the economy. We looked specifically at the environment and then at politics slash geopolitical issues. And as you can see, there is very often at the next level down an interconnectedness between the issues. So I'm picking, for instance, here the global connectivity and pervasive technology slash then ultimately the aspects around an environmental crisis. And what you can see here is ultimately that there is more global connectivity, there is pervasive technology at the same time, and hence there's an increasing amount of risk when it comes to, for instance, cybersecurity and data privacy. In the same time, through interconnectedness, we're creating more data, and hence that might lead to opportunities when it comes to digitization, automation. So in the same, but last but not least time, we are also seeing through global connectivity the increasing issues when we look at inequalities, when we look at social instability, what we discussed a bit earlier on, and ultimately the rise of populism. And again, there is a fine line with understanding what weighs negatively and what weighs positively, so we call that net impact, into an equation when assessing a current state of affairs, ultimately assessing a corporation and its activities, and how it actually contributes and maybe either impacts negatively or positively some of the environmental or societal issues. And that's ultimately what ESG is about. It's understanding these patterns. Historically, again, when we looked at this 20 years ago, the focus was predominantly on downside protection from risk. And increasingly, we have over the years launched thematic investment vehicles, impact investment vehicles with these positive outcomes. And we are looking increasingly at actually generating opportunities. And that is, again, at the bottom line, what the Sustainable Development Goals should all be about. If you flip over to our next slide, you can see here actually an interesting study on done by the Morgan Stanley Institute, and they look at sustainable signals. It's a Sustainable Investing Institute. They look at sustainable signals, as they call it. It's a regular report that's coming out that I really recommend, especially the next and young generation, to read with quite some interest, because it tries to map and match the key themes that are prevalent, that are making an impact to us as individuals and consumers, for instance, as well as investors. We shouldn't forget we have monetary power. We are retail investors. We very often have pension funds. So we should actually ask the questions around investment, as well as the questions around what do I want to buy more sustainably on a day-to-day basis. So here, this study in particular has identified a couple of key themes. First of all, up and foremost, no surprises, the key themes that the young generation, but also others, are most concerned about are climate change, followed by a very strong socially led theme, and that's obviously diversity, up and foremost gender diversity, but increasingly ethnic and age diversity as well. And there is, in line with these sort of how we call them and classify them, values investors and beliefs. So the young generation wanting to reflect their personal beliefs into their day-to-day activities. There's also a trend here in how they're actually aiming to invest. And as you can see, over the course of the last 5 years, the interest in sustainable investing actually has grown. I mean, you can see it here from the general population and the millennial population. The millennial population was always slightly bit more interested in these topics, but both areas have actually grown year on year. And this is actually a study, and this is another important point, that's done in the US with ultimately 800 US individual investors with what we call investable assets of $100,000 and plus. So we're talking here of a good segment in the market, but particularly in a market that is renowned for not maybe being most interested in sustainable investment strategies per se. And by the way, Europe and increasingly China and other markets are really at the forefront when it comes to policy regulation, commitments from companies and investors at large. But this here is showing that the trend in society in the US and amongst the investors community is actually growing, regardless of the political agenda. And there is increasingly an adoption of sustainable investing. So, I highlighted that sustainable investment assets have grown worldwide. That's a worldwide phenomenon. I should also mention that on what we call the fixed income side, the other asset class, green bonds that have been issued first and foremost by multilaterals and development banks, but now increasingly and very powerfully by corporations, that they are making quite an impact as well. So they have grown from less than $10 billion just 10 years ago to over $250 billion by the end of 2019. So again, you can see really here a trend that asset classes that assets across asset classes are growing in sustainable investment strategies, that society at large is interested in the topic, and increasingly millennials are engaging on it. And I can say now as a mentor, the mentees I've worked with, Carlotta and Albtram, both have a very strong interest and are actually working in the field of renewables / sustainable finance. And we had very inspiring discussions in how we can actually jointly work together on initiatives, on shaping the future, on working with the community at large. And we had some fantastic initiatives with Carlotta, for instance, on bringing more attention to the fact that fashion is one of the largest contributors to climate change impacts, given their huge emissions, their huge pollution-related issues to the entire production and supply chain of the clothing industry, not to mention even, child labor and other labor issues and implications if you look at societal issues. But for me, that's showing, that really having that engagement as a mentor with the mentees, you can really contribute and make a difference, regardless where you stand and with whom you work, at which level in society or within a corporation. I think what's important for the next generation is A, to get educated, and B, to get engaged. I think the Sustainable Development Goals, goal number 4, asks for quality education. And actually, when I returned from Davos at Zurich Airport, they had a wheel of SDG fortune. So they put the SDGs up on a wheel of fortune, and I rolled the dice, I rolled the roll, and I actually hit on quality education. So for me, again, working across industry and academia, having been a universalist all my life, and try to then interconnect the different areas that I've learned about, from my legal education to my financial services background to working on and with sustainability issues, initiatives, and networks, I've tried to interconnect and intersect what is happening and how actually the wider worldwide issues, the macroeconomic themes, are impacting me and us on a day-to-day basis. And I hope really, actually mentees and others listening in, getting engaged on the key issues, listening to some leading voices, but also to people on the street that are trying to make a difference, from the more small-scale initiatives to the large-scale investor coalitions, there's ultimately the same theme prevailing. You can make a difference. And for me, it is important that we're keeping that message, that spirit, and that in interconnectedness alive through the different networks. And I think that the Global Thinkers Forum is a prime opportunity for meeting really with leading thinkers, getting their knowledge, getting their information on what's shaping our world today, and trying to make that actually happen at any type of level further downstream, so to say, in your day-to-day life or through your work activities. And I'm making the call, whoever would like to, reach out to me to get more information about the work that we do in sustainable investing or sustainable finance, that would like to get connected via the Network for Sustainable Financial Markets, or that would like just to keep on track of what's happening in the industry, please continue, obviously, to follow us, follow me via Twitter, LinkedIn, and other social media sources. Sure. I think, one thing that's prevailing for my generation, and definitely the one that have now coming after me, that is there was no security. I think when I look and compare my life with my parents, both of them been civil servants, very stable work life and personal life balance, living in a suburb of a big town, having a secure setup, structure, family all around them, also being in Germany, one of the booming economies. I can say there was probably security, there was a safety net. What I've experienced over the last 20 years now, soon, of my personal life and career, is that you have to adapt to change, that you have to be flexible enough, that you have to actually understand, not only teach about the themes and trends that are shaping our world and shaping our lives. And I've literally started myself, as you briefly highlighted and mentioned, in financial services, but after in sort of an academic education on the legal side with a strong focus on human rights and labor rights. But when I literally finished my education, I wasn't sure where and how actually a legal education, if I wasn't to become a lawyer, would actually and could potentially lead me to and get me to. So I started and took the chance to start an analyst training program. I joined a large scale firm, Deutsche Bank at the time, and I realized that actually through monetary movements, we could make a real difference. So, I saw the policy agenda and how some of our legal provisions are shaping our world, our day-to-day lives, but I couldn't really see how they can make an impact. And I realized, with working through and in financial services, I could actually create a longer term impact and make a meaningful contribution to some of the initiatives and activities out there. And it was literally a pure strike of luck that when I moved to the UK, I was offered the job in socially responsible investing. I mentioned it to someone else here today. No one else at the time wanted to do the job. It wasn't trendy. It wasn't making a lot of money. It wasn't, looking at the key financial issues that everyone talked about. It wasn't about shareholder performance, as I highlighted to begin with. It was about creating a more connected, stakeholder-led community and a collaborative engagement approach, which at the time were, by the way, no defined terms per se either. And I was then lucky enough to move and make another transition from actually the investment management industry and banking side onto the service provider side, again, where I learned a lot in the last decade about data, information, analytics, and indices, how actually products are constructed, how they can make, again, a meaningful contribution to avoid some of the key controversies we are facing. And it's probably no surprise that my main areas of interest remain around natural capital and biodiversity, but they also remain strongly focused on the social agenda, especially around human rights and labor rights. And I was fortunate to be named actually one of the top influencers in tackling modern slavery back in 2018, because I did a lot of work in the UK in and alongside corporations before and after the launch of the Modern Slavery Act UK. And I encourage everybody, again, to pursue your passions, to actually try to combine what you do in regards to your personal interests with actually making a meaningful contribution in your work life. And if you can create that balance, I think I feel I'm much more safer now. I'm back to where I wanted to be versus of becoming a civil servant per se and follow my parents' footsteps. I just would like to thank you all for your time today.